We're revisiting a biotech company that many of you watched closely 9 months ago, Ceribell Inc. Back then, this stock was just starting to catch attention. First, let's talk about valuation, because this is where the biggest change has happened. Ceribell's market capitalization has increased to around $814 million, up significantly from last year. That tells us one queer thing. The market is now valuing this company much higher than before. At the same time, the enterprise value stands at about $667 million, which means the company still carries a strong cash buffer relative to its size. However, compared to earlier, the valuation has become more expensive, so expectations from the company are now higher. Now, let's look at ownership trends, because smart money usually moves before headlines do. Insider ownership has increased to 5.73%, which is a positive sign. Management now has more skin in the game. Even more important, institutional ownership has risen to over 56%. That means large funds and professional investors are showing stronger confidence than before. This shift suggests that Ceribell is no longer a niche speculative biotech. It's now on the radar of serious long-term investors. However, there is one major development investors must understand clearly: massive share dilution. The total shares outstanding have jumped by more than 535% in 1 year. This is huge. While dilution helps the company raise capital for research and expansion, it also means each share now represents a smaller piece of the business. So even if the company grows, returns for shareholders may be more muted unless revenue growth accelerates strongly. This is a key risk factor you cannot ignore. Speaking of growth, let's move to financial performance. In the last 12 months, Ceribell reported revenue of approximately $83 million, up from earlier levels. That's a solid improvement and confirms that the company's technology is gaining real commercial traction. Even more impressive, the gross margin is nearly 88%, which is exceptional for a medical technology company. This tells us that once operating costs stabilize, profitability could scale quickly. But for now, the company is still in the investment phase. Ceribell reported a net loss of about $52 million, with a loss per share of $1.50. Operating margins and EBITDA remain deeply negative, which shows that R&D, clinical expansion, and operating costs are still very high. This is typical for growth-stage biotech companies, but it also means patience is required. Now let's check the balance sheet, because this is where risk management matters most. Ceribell currently holds around $169 million in cash, with only about $21 million in debt. That leaves the company with net cash of roughly $147 million, or nearly $4 per share. The current ratio of 12.65 clearly shows strong liquidity, meaning the company is financially stable in the near term and not under pressure to raise money immediately. Efficiency metrics still reflect the growth stage. Return on equity, return on assets, and return on invested capital all remain negative, mainly due to continued losses. However, revenue per employee is close to $300,000, which indicates operational productivity is improving as the company scales. Let's now talk about stock behavior and market sentiment. Over the last year, the stock is up roughly 9.5%, which is far more stable compared to the explosive rally seen earlier. The RSI, around 56, suggests the stock is neither overbought nor oversold. Short interest has declined slightly, with only about 4% of shares sold short, reducing the likelihood of extreme downside pressure from bearish traders. From an analyst perspective, the tone remains optimistic, but more realistic. The average price target is now around $24.67, implying a moderate upside of about 12% from current levels. All 6 analysts covering the stock maintain a strong buy rating, but the expected upside is clearly lower than before, reflecting the higher valuation today. So, what's the final takeaway? Ceribell is no longer a deep-value biotech under the radar. It is now a higher valuation, institutionally backed medical technology company with strong revenue growth, excellent gross margins, and a solid cash position. At the same time, heavy dilution, ongoing losses, and rising expectations increase the risk if execution slows down. This stock now fits best for long-term investors who understand biotech cycles, not for short-term hype trading. If Ceribell delivers clinical success and continues scaling revenue efficiently, today's valuation can still be justified. But if growth disappoints, volatility will return. Now I want to hear from you. Do you think Ceribell still has multi-bagger potential from here, or has most of the early opportunity already passed? Drop your view in the comments. If this updated breakdown helped you, hit the like button. It really supports the channel. And for honest, data-driven stock analysis without noise, subscribe and stay ahead of the market. See you in the next video, and until then, invest wisely. This is not financial advice, and biotech stocks can be highly volatile.